Join us, won't you, in the Simple Plan community. We seem to have had a bit of a technical glitch there, so let's go back to the top of things. Today we're going to be talking about not quite sure what happened there. Technical difficulties on the internet, imagine that. So today we're going to be talking about looking in greater detail at the new hybrid plan we've been talking about for the last few weeks, which offers security, guarantees, and tax freedom. So today we're going to drill down. We looked at a plan, a kind of an overall plan last week. Today we're going to drill down into what we mean by guarantees and what some of those guarantees look like. So as I was saying, I want to thank the Simple Plan community, our sponsor. You can join us over there at facebook.com/groups/Simple Plan community. So we're living in some interesting times right now. Of course, we've got inflation running away like it hasn't in 3 or 4 decades, which is a lifetime for a lot of people. And believe me, I've lived through a number of these phases. When I was young, I certainly remember double-digit inflation being pretty crazy, and the government implementing wage controls and price controls and all sorts of controls, which sort of semi-helped, but also semi-made the situation worse. Really, the single form of monetary policy the government has to deal with inflation that seems to have some effect is raising interest rates, which we're also seeing go on. We've had a couple of interest rates already this year, including an interest rate rise that we hadn't seen for several decades again. And we're going to see another one of those probably just here in a couple of weeks, and more for the rest of the year, I expect. So fasten your seatbelts. We're in for a bumpy ride, as the famous movie saying goes. So amidst that bumpy ride, what would we like to see? Well, we'd like to feel some security, and we'd like to see some guarantees. So the time's never been more right for the right people for this particular plan that we've been looking at. So I want to drill down into it. We're going to look at some of the options that you have available inside this plan and the results of it. So, I don't like to get overly technical with numbers, but when we're talking about these kinds of benefits and features, we need to talk about what people are going to receive. Now, bear in mind, this plan can be configured in many, many different ways. So I'm just showing a single example. The example I'm showing here is for a hypothetical couple, 33 and 35 years old, who want to have some guaranteed value to leave for their family for an estate, and also would like to see some guaranteed return or growth on cash deposits, because that's what we're really struggling getting. We have been for a decade. So I want to clear up a couple of things, maybe before we drill down in there. The first is, this is not an all-in-one plan. That is, that this is the only thing that you'll need and all your money should go in here. There have been plans sold like that in the past, and they've usually not worked out very well. Generally, often not providing great returns. So when we talk about an investment plan, usually we're talking about some kind of a balanced portfolio that has equities in it. We advocate for equity mutual funds, but some kinds of equities are stocks, and some combination of bonds, treasury bills, and other interest-bearing types of investments that provide some stability, if not some guarantees. Some do, but often not. And so what we've been seeing, though, for a couple of decades now is that bonds have not been performing well. They have not been providing the normal stability that we'd like to see inside these balanced portfolios. They've just been not doing well at all. And I don't think they're going to do that well for a while yet because of the interest rate rise that we're experiencing. So things are going to be a little uncertain on that front, continue to be. So if you're looking for some solid returns on cash deposits, where can you get them? Well, inside this hybrid plan is an opportunity for you to stash some cash and get a reasonable rate of return on that cash inside the plan. So those are the guarantees. Those are some aspects of the guarantees we're talking about. So let's have a look at what those numbers exactly look like. So again, this is a plan configured for a 33 and 35-year-old couple. They have children, and they're looking for a combination of things. They're looking to leave some value for their estate. For now, they want that value there because they want some money for the children to be raised. But they also would like to see some long-term value to be able to leave something for their family down the road, children and grandchildren and such, and their favorite causes. So, of course, they could just save for the long-term aspect of that, but you can't just save for the short-term aspect to continue to raise your children if something happens to you. That's what we use life insurance for. So we've got inside this plan guaranteed estate values, and we have cash values, guaranteed cash values, and projected cash values. And so I'll talk a bit about the difference between those two in a moment. But let's start by just saying that this couple is going to be putting $500 a month into this plan. Now, $500 a month, again, we're not looking to take 100% of their savings and security money, monthly money, and put it all in a single spot. I would say generally we're going to be looking at about probably $500 going into this part of the plan, which is going to give them a bunch of financial security, as well as cash deposits that grow at a guaranteed rate, and also can receive some upside benefit in better times. But they're still going to continue to make deposits into an investment account that's more aggressive, that's based on equities. We're just really kind of splitting out the two balanced components of their plan. And rather than putting them in the very poor performing part of the balanced plan that's been conventional and not performing well for the last 20 years, we're instead putting it in this new hybrid plan so that they can get the advantage of better returns and guarantees and some either tax sheltering or out and out tax avoidance on this. And by the way, when I say tax avoidance, I am strictly referring to legal means where we're allowed to arrange our affairs in such a way that we don't have to necessarily pay tax depending on how we've structured things. So in this case, we've got your guaranteed estate value right out of the gate. And let me just pull up a tool here. All right, so we've got a guaranteed estate value right out of the gate of $402,000. And we're going to see that that's going to increase. In fact, we can see it increasing every year as time marches on here. Now, this rate of return on death, that's just a rate of return on the amount that they've actually put into the plan. So if they had only made a year's worth of monthly deposits into this plan, $6,000, and they passed away, they would be receiving their heirs, their children in this case, would be receiving $403,000. So that is a 30,558% rate of return. That's interesting and kind of amusing, but of course that's not the point of this type of a plan. Where it does become a point is down the road when we see at life expectancy what the rate of return is on the money that we've put into this plan. So then we have projected cash value here. And here we go. The projected cash value is the value that's expected to accumulate inside the plan, whereby you could actually collapse the plan and withdraw the money. So in this case, the projected cash value is $2,761 at the end of the first year. That's based on the historical track record of the underlying fund that the cash goes into in this plan. And so in this case, they would have deposited $6,000 into the plan. They'd have had the financial security, the insurance portion that's guaranteeing them $403,000 in the event of their death. which there's an insurance cost to that. And of course, the projected cash value, they could withdraw that, they could borrow against it, whatever they like. So let me just pull up a bigger. All right, there we go. Okay, so now the guaranteed cash value is worst case scenario. So if we imagine that economic conditions get really bad, they are still guaranteed a cash value. Now the guaranteed cash value does not accumulate rapidly in the early years because there are many costs associated with setting up these plans that get recovered out of the plan initially. So once they've been recovered, that's when your cash value starts to really accumulate. So we see that down here, years 6, 7, 8, 9, 10, that things really start to pick up. So, and after 11 years, you've got almost $25,000 in cash value that's accumulated. That's the guaranteed cash value. The expected cash value, or the projected cash value, is actually $60,000. And it's quite possible that that number will go up as interest rates rise, because insurance companies are very dependent on lower risk rates of return on their accumulated and aggregated funds for these plans. So the projected cash value, in my opinion, while it's not guaranteed, it is likely to be higher. It is likely to end up higher than that. So if we hit that projected cash value, then what's happened is we've spent, or we've made deposits of $66,000 over 11 years at $500 a month, and we've accumulated cash value of $60,000. Meanwhile, we've had many, many thousands of dollars of life insurance premiums paid through that period. So it's as if we now have close to free life insurance. Now, a couple of other interesting features we're going to talk about down the road. There's a disability benefit. So we'll talk about that next week when we talk more about security. There's also the tax aspect, which again we'll talk about next week when we get onto that topic. But one more thing at this stage that I wanted to draw your attention to is what we call the premium holiday. And so what this means is that once you've made some deposits into your plan, and this is unlike most insurance policies, that you can actually stop paying your premiums for a period and your policy won't lapse. For example, with term insurance, if you are unable to pay your premiums, and with all the uncertainty of the last 2 years, there's been a lot of people that have had a difficult time making their premium payments. If you're unable to pay your premiums, then you are going to end up losing your insurance. 30 days after you stop paying your premiums, your policy will lapse. But this policy, this hybrid structure, has a new feature built into it where you get a value within it that you can draw on and stop paying your premiums for a time. So again, it's a little low in the first, even in the first year though, you could take 0.9, which is about 11 months of a premium holiday. You could stop paying your premiums for 11 months and your policy would not lapse. Once you get a couple years, 3 years into this, you could go for 12 years without paying your premiums. Now, your cash values are not going to accumulate if you're not paying your premiums. They're going to get stuck wherever they were stuck at. But you could take 12 years of a holiday from paying your premiums and your policy would not lapse. And once we get out 11 years, you can now go for life and your policy will not lapse. So these are a number of nice to have features because it gives us the ability to be flexible. Now, also, if you decide that you've got more money that you might want to set aside into this plan, we're not even maxing out. We're not putting the full amount of deposit into this that you actually could. So you could put some additional deposit into it and increase all these values all the way around as well. So now let's look at, this is all great. This is early years. I'll just scroll up, when we get into some of the middle years. So these folks are now 53, their kids are getting to the point where they're going to school. Well, we have a significant amount of cash value accumulated now. And you can withdraw that cash value, but if you do, you're going to pay tax on the growth. However, so we've got our guaranteed and our projected cash values. Now, a better route, and by the way, if you withdraw the cash value, you are either diminishing the face value of the policy or collapsing it entirely if you take all of it. But a better route to go is that you can get low interest loans against these funds. So let's say, for example, you wanted to borrow some money to buy a car, or you wanted to borrow some money to help your children get through college. Well, rather than going to systems that you can't control, borrowing for student loans or getting car loans or what have you, you could take the cash value and get a loan against the cash value from banks. They will do that, and you can get up to a certain maximum at a relatively low rate of interest. It's secured by the policy itself. So if you don't make the payments, they can access the cash value to make the payments, or of course, if you die, then the proceeds, a portion of the proceeds would be used to pay out whatever the amount of the loan was. So that's just another kind of nice to have along the way. Now, where things get really interesting is down the road here. As we get to life expectancy, which for these folks starts, around, I'm going to say age 57, or year 57, sorry. It's probably a little earlier than that, but I think if we anticipate the advances that are going to continue to happen in people's health and in health care, that we're going to continue to see that life expectancies are going to extend. So when we get out here, so this is now age 91, we see that the guaranteed amount that's going to the estate is $879,000. Now, the interesting thing is what that represents is a 2.9% rate of return on death. Now, admittedly, you can say, well, 2.9%, that's not a high rate of return. And I would say, well, yes, that's true. However, it is a rate of return. It's a guaranteed rate of return. So that means, again, we're looking at worst case scenario here. You pay you make these deposits and you're getting a 2.9% rate of return on death. But even more importantly, it's tax-free. And so we'll look at what those numbers mean. But that's a significant savings, because we know, especially when you're talking about major sums of money, if you had this kind of money growing for this length of time, and now you had to pay income tax on the growth, you would be paying a significant proportion of it, perhaps somewhere 30 to 50%, in which case you have to add that on to this 2.9% rate of return. So if we add 50% onto that, we're actually at about nearly a 4.5% rate of return on death. And again, by this time, the projected cash value is quite high. So you could be borrowing against this, you could be living off this in retirement. We're going to talk about that as well in another week. And then again, we've got the guaranteed cash value under the worst case scenario, but we anticipate that the values will be much more in line with the projected cash value. You'll see we talked about the premium holiday, which you can initiate at any time. We didn't talk about the disability benefit. We will talk about that next week. So I just wanted to share that with you today. If you want to see more, watch our last week's episode, which was more about the complete picture of this kind of a plan. And also, you can go to our YouTube channel. You'll find that there. You'll find the prior week, and you'll continue to be able to see the replays. We'll replay this week. We will have all our future episodes up there. So you can go back and watch all the different features available in this. Now, if you'd like to learn more about this, how it might apply to you personally, to your family individually, it takes about an hour for us to do a strategy session to go through whether this plan might benefit you or not. It's not for everybody. Some people aren't looking for that kind of solid, clear structure of how this might all play out and the commitment required to benefit from it over a long period of time. But for people who are looking for these types of guarantees, the tax sheltering, the tax savings, and the financial security for your family that comes with this, it's a great plan. It really is. So if you were interested in looking at that, what you can do is book a time on my calendar. You can do that at go.getthesimpleplan.com. And it's /calendar-new. And you can book a time on my calendar. And we'll sit down. Now, the initial session, as I say, is about 45 minutes. We're going to ask you for a bit of information before that so we can be well prepared for your strategy session. But you can go there. We're going to add that to the comments there. And so click now, book yourself a time. We'd be glad to sit down with you and go over the details of how this type of a plan works and whether it's for you or not. As I say, it's not for everybody, and it's fine either way. We're not on a big sales pitch. We just want anybody who's interested in this kind of a plan to have an opportunity to look at how it might benefit their family. So thanks very much for joining us today. Really appreciate your time. I hope you have a great rest of your day. And we look forward next week to drilling down further into 2 more aspects of this hybrid plan. Thanks very much, and we'll see you next week.